What is up, Theta Mafia guys? How are we doing? Today, guys, we're going to go over the option basics, something that you guys been waiting for a while. I got tons and tons of DMs. A lot of people saying, Kane, can you teach us options? Can you go in a little bit depth on the options because I don't know what I'm doing. So here's that video for you guys. Now, I do respect your guys' time. I'm going to try to keep this video short and simple as I possibly can. Guys. And we aren't going to get into a whole bunch of fancy stuff. I'm just going to show you guys how to buy calls and puts and how to sell calls and puts, and then show you guys the options chain and what that stuff is. So I'm already going to throw you guys a lot of information, and I just don't want you to be overwhelmed, okay? Now, with that being said, please take screenshots of these next photos that I'm about to show you. Okay, now we're going to label what's different between stocks and options. So stocks represent ownership in a company, voting rights, and dividends. Stocks never expire. No leverage. One share represents one unit, medium to high risk, versus options offers no ownership, no voting rights, or dividends. All option contracts eventually expire. High leverage. One contract represents 100 shares, generally higher risk. Now these next photos I'm going to show you, please take a screenshot. Buying calls, buying puts. When buying a call, you have the right to buy a security at a specified price. When buying puts, you have the right to sell a security at a specified price. Selling calls. When selling calls, you have the obligation to sell a security at a specified price. When selling puts, you have the obligation to buy a security at a specified price. Guys, this is the option Greeks. Now, the most important ones that typically a lot of option strategies come from are delta, theta, and vega. Rho and gamma, they're important too, but pretty much delta, theta, and vega are the most important in the option Greeks. All right. Now, we aren't going to go over the option Greeks as much. If you want me to go over the option Greeks in the future, we can, but please take a screenshot of this. We'll go over a little bit of delta and theta. All right. But we won't go over much gamma, vega, or rho. Okay. So please take a screenshot of this because you're going to need it in the future with future videos. This is what theta decay is, and that is one of the options Greeks. So we'll just talk about theta. Theta is defined as the rate of change of value of the portfolio with respect to the passage of time, with all else remaining the same. It is sometimes referred to as time decay of the portfolio. And this is important, so please take a screenshot of this, guys, when you're selling options and when you're buying options, because as a seller, you're going to be sucking the premium from the buyer, and as a buyer, you're losing premium to the seller. Okay, and this shows you a chart of time decay, aka theta decay. Shout out Theta Mafia. Okay, now we aren't going to go over this as much, but this is important for future videos. This is in the money, at the money, or out of the money. And the reason why we're not going to go over this, guys, because this is some options lingo that a lot of people use that it's all right, guys. But I don't want you guys to be confused. So take a screenshot of this if need be. It tells you basically in the money, at the money, or out of the money when it comes to selling options. It's just lingo. I don't want you guys to... This is like some of the least important information. I mean, it's important, but at the same time, it's just telling you if the strike price to current price of stocks. It's lingo that we use, okay? Probably be important for future videos, so please take a screenshot of this if you want. And this is basically it in a graph. Take a screenshot of this if you want. It tells you when the call options in the money, at the money, or out of the money. Same thing with the put option, okay? So with that being said, if you take a screenshot of all this stuff, guys, this will all be useful in the future, and we'll actually go over some of the stuff. We might go over some Greeks today, just delta and theta pretty much, and then we'll get you cooking. Okay, guys, I'll see you in a minute. For today's example, we're going to hit SoFi, and we're going to use SoFi for all our examples today. Now we're going to hit trade and trade options. Now what you see right here is option strategy builder. You have all the different strategies that you can do, and Robinhood makes it easier for you to do. It's just hit one of these strategies and it'll get you started, and you just pick the contract that you want to pick and the expiration date. So if you think stock's going to go up, you can do single legs and vertical spreads. If you think stock's going to go down, it has your choice of a single leg and your vertical spreads. And if you think it's going to go up or down, you have your straddle strangles and calendar spreads. And if you think it's going to change, if you think it's going to go sideways or the price pretty much stay the same, you have your calendar spreads. Now, we're just strictly going to focus. Now we're going to strictly focus on selling puts, selling calls, and buying puts. That is the options basics. And almost every strategy that you've seen that we kind of just went over. Now it's not every strategy, but almost every strategy that you've seen, it's all off the basis of selling puts, selling calls, or buying calls and buying puts. All right, so we're just going to go over the basics. Next, what you see are dates: February 24th, February 21st, February 28th, March 7th, and we can go all the way out here, from March 20th, 2026, all the way out to January 15th of 2027. And then other expiration dates on, like, let's say ETFs, you have dailies. So the QQQ and the SPY, they have daily expiration dates because a lot of people trade them securities. Okay. Now, with me, we're just going to go March 14th because I usually like to do monthly options. All right. And we're going to go sell. You got buy and sell. So we're going to go sell first. And you got call and put. We're going to do put first. Okay. Now, this is the options chain. No matter what brokerage you use, the option chain should be similar or pretty much the same. It might look a little bit different depending on the brokerage you're using. We're using Robinhood, obviously. So on the left, you see prices with the dollar signs. You see $17 puts, a $16.50 put, $16 put, and a $15.50 put. And we can go lower to a $5 put, and we can go the highest on this underlying security is $30 put. Okay. Below that, you have your break even of 1542, which we'll get into that later, and your chance of profit, which is nice to have. So it shows you 90%, and then if we go all the way up, 41%. Some of them are a little bit different, 0%, but that is your chance of profit. I wouldn't fully rely on the chance of profit, because it's always ever changing. And then on the right hand side, you have your premium. Now, when you're selling calls or selling puts, you are the one that receives a premium. When you're buying calls or buying puts, you're the one that pays the premium. Okay, so you'll receive a credit on the selling side, and then you'll pay a debit when you're on the buying side. So this is the options chain, and then obviously you have the share price in the middle right here. I circled everything for you guys, so it'll all be easier for you guys so you can all understand. Now, cool thing is, all of the option contracts will be similar. It'll look like this. So this one's the $16 one. We'll go to the $12 one. And we'll go to the $18 or $19 one. See, they're all very similar. The layout is similar, but the numbers are obviously different, okay? So we're going to go into the $16 put contract, and we're going to go over just a little bit to get you guys familiar with it and show you guys the important stuff, okay? Now, first and foremost, you have the label of the underlying contract that you picked. So we picked sell SoFi, $16 put at the date of expiration, which is March 14th. Next, you have the bid and ask. This is the buyers. The buyers are the one that are bidding. They're trying to get it for cheaper, and the sellers are the one that's asking because they want it to be more expensive. You have people trying to do 4 contracts, and you got the asks trying to do 15 contracts. That will always change when the market's open. Go up and down and fluctuate. Now, the mark. The mark is pretty much in between the bid and ask. That's not really important. Last trade is 80 cents. That means the last trade was either the day of before the market closed was the last trade. So in this case, Friday, February 14th was the last trade, was at 80 cents for the bid and ask. The IV, which is implied volatility, is a measure of how the market expects the asset value to change over time. It's a key factor in options trading. Okay. The previous close, high, and low, guys, that stuff's not really important. It's pretty much self-explanatory. The previous close, the high of this contract, and the low of the contract. The chance of profitability Guys, that's not always accurate, but it's pretty close. The volume, basically how much people traded this contract, this specific contract. And open interest is the number of active contracts that have not been settled. So it's a key indicator of options liquidity and trading activity. So they're active contracts, but they just haven't been settled yet. And then you have the Greeks. Now, like I said before, the most important ones are Delta, Theta, and Vega. But pretty much today, we're just going to talk about Delta and Theta. So Delta, I want you to think about Delta, to put it in simple terms, the chances out of 100. We have 42 times out of 100 that the share price, which is at 16.21, will reach our strike price or lower. So 42 times out of 100. So it's not quite half yet, but it's pretty close. And the theta is basically theta decay. So when we're on the selling side, that's how much money we're going to receive every day that we're taking away from the buyer of the put. So close to, it's like a penny and almost 2 pennies. Okay. Now, that is what a contract block looks like. I call it a contract block. Okay. Now, like I said earlier, it's all pretty much the contract block is going to be the same, but at the same time, the numbers will be different depending on which one you do. So that is the contract block. We did one. Nobody's trading this because of zero volume. Okay. So that's what that is. Okay. So it'll be the same. We're going to go over that one time. All right. Get into actually selling a put. Okay. So for me, I typically look at the share price. And why would you want to sell a put? You either want to sell a put to get into the underlying security at a cheaper price, or you're strictly doing it for premium. Now, depending on what you want to do, you can do both. Now, what I like to do is I like to get 2% of my money. Now, if we look, let's say at the $15 strike price, that's 40 cents per share. Times that by 100, because one contract equals 100 shares. So that's $40. And the same thing with the strike price. $15 per share, 15 times that by 100, that's 1,500. Now, what I like to do is I'll take the full premium, which will be $40, and divide that by the full strike price, which will be 1,500. Because remember, one contract equals 100 shares. And we'll divide that. And so for that play, we would get 2.6%. So just a little bit above 2.5% premium on my collateral. So we just locked in 2.5% gain right there, unless if we decide to buy the position back. So I like that. Then I go in here and I look at my key indicators, stuff that we already went over. So the IV I look at, I circle that. The volume, I look at that. I think that's good. And the open interest is good. I just circled that. The delta, I like anywhere from a 20 to a 30 delta, 0.20 to 0.30 when I'm selling puts and when I'm selling calls. The theta is good to me. There isn't really much of a theta that I really care for as long as the premium is good. And we got a chunky premium. So this right here, the one that we just typed in, is how many contracts you want. So we did one contract. Now our collateral for selling puts is money, aka cash. That's why we call it a cash secured put, because your collateral is cash. Now you're going to do your bid and ask. Now if the market was open, you would have the bid and ask going up and down, right? Now, if you want your contract to go through, you pretty much go closer to the bid. If you want to risk it and think the underlying might go up or down, you can go closer to the ask in hopes that you can get more money out of the buyer. In this case, we're just going to do a simple 40 cents. Okay, then we go down to our estimated credit. We look 40 cents times that by the multiplier, aka one contract equals 100 shares. That'd be $39.96 because we have a 4-cent regulatory fee. Now, if we look down the P&L. Now, I know it says the max loss is $1,460 and the max profit is $40. And our break even is $14.60. How do we get our break even? Our break even is the strike price, which in this case will be $15, minus the estimated credit. In this case, it would be $40 minus the regulatory fee will be $14.60. Now, Kane, that max loss looks scary. I know that. The only way you can lose that max loss, which is $1,460, is if SoFi goes to zero. Okay? That's the only way you're going to lose that amount of money. So it's kind of deceiving. Unless if you think SoFi is going to go to zero, hopefully you would be the buyer of this put option. We are the sellers. Now, if it stays above pretty much our strike price, so even if it's at $15.01 or higher, what would happen is you would get to keep your max profit, aka in this case $40 minus the regulatory fee, and you would get your collateral back by the date of expiration. So let's say March 14th happens, you let it expire worthless, and we'll get into an example of that later because I'll show you one of my examples that I'm already currently doing. And it expires worthless, and you get to keep that max $40, and you get your collateral back. In this case, our collateral would be $1,500, and I'll show you that later. Okay. If that happens, that means you don't have to buy SoFi at $15 because the price will be either at $16 or above the strike price. And in that case, you just made a free $40 for just the potential of buying the underlying security. Now, if you're at $15 or below, no matter if you're at $15 or if you're at $14.24 or $10, you still have to buy the underlying security at $15. Now, your break even is it takes into consideration that estimated credit you have. So, your break even, more than likely, if you have to buy the shares, will be your average cost. Okay, so our average cost would be $14.60. All right. Now, the downsides of selling a put. The downside is, the stock can go to zero, or the stock could go like, let's say $10, and you still have to buy at $15 per share. That sucks. And that's the risk that you have to be willing to take if you want to sell options. Now, the delta tells us, if we go back to the delta, remember, this only has a 26 out of 100 times of this actually happening. So 26 out of 100 times would this contract expire at our strike price or below our strike price. And I like those odds. Those are pretty good odds. And if worst case comes to worst, I'll buy the shares and I'll just sell cover calls on it. Okay, which we'll show you in the future. Now, what's the pros of selling puts, Kane? The pros is we're selling puts currently on SoFi at $15. The current price of SoFi is $16.21, right? We are getting paid the potential to buy SoFi for cheaper. We're getting paid $40 to do it, our estimated credit. So we're getting paid to buy stocks, or the opportunity to buy stocks. And if not, we still get to keep the estimated credit. That's what I like about selling options. Because if I want to buy the shares, I'll just sell a put. And if it goes through, I'm happy to have the shares. And if not, I just made a quick $40 off of nothing, right? And so that's the pros and cons. The pros and cons are pretty simple, and I like it. So after everything's said and done, this looks good to you, we hit review. Now, you are agreeing to buy 100 shares of SoFi at $15 per share on or before March 14th. If you aren't asked to buy SoFi by then, you'll keep your collateral and the full $40 credit. Note, this does not include regulatory fees. Okay? If we do that, we just submit it, and it goes through. There we go. We have been filed. See, we have 2 of those. Now, let's go to an option that we already did it on. In this case, we did the $14 put. Okay, now we did 2 contracts, so that's 200 shares. The current price of this is 7 cents, right? And when you're selling puts or selling calls, you want the current price of this contract to eventually say 0. You want it to expire worthless, okay? And the reason why is because you want to suck up all the intrinsic value of the premium that you receive, aka in this case 32 cents per contract. Okay, so if we look at this, our average credit was 32 cents. We go over here, and this was about 32 cents right here. And look, theta decay. And because that theta decay kicked in, we got a total return of $50, aka 78% for our total return. My break-even price, if this went through, is $13.68. The current price of SoFi is $16.21. And then you have your stimulate returns. If the price stays relatively the same, we got 12 days left, DTE, date to expiration. And if we just move this along and the price stays the same, we're still theta decaying until we reach that max profit. And then when we reach that max profit, the contract should expire worthless. Now, if the price goes up, look how quicker max profit's reached if the price keeps on going up. If the price goes down, look what happens. We still get to keep that, guys, remember, we still get to keep that 32-cent credit. And it goes down and down. And then there's my break-even price, right? And this goes down. Now, this shows what I bought it for and what it's currently the price is. So technically, after I bought the shares, I would be down basically $196 because that would be the average cost of what I bought it for versus the current share price is at right now. Okay. Now that is, guys, that is everything. That's how to sell a put. And now if I wanted to get out of this contract and I wanted to buy the contract back, since we're selling it, you would hit trade, you would hit buy, you would hit 1. And for this case, we'll do 6 cents. And we'll do 2 since we have 2 contracts. Sorry, guys. $12.08. Now, if we do that and we subtract the average credit minus the $12.08, let's just get rid of the 8 cents. That'd be 20. So I made $20 per contract just for the opportunity of buying it if I decide to buy the contract back and get rid of it. Rolling a position, guys, that'll be for a different video. If you guys want to see that video, drop a comment down below. Now, that is selling puts on Robinhood. Now, we'll go to March 14th, keep the same expiration date, but we'll do a selling a call. Now, let's say we come back here real fast, and let's say the contract goes through. That means the intrinsic value will be higher, and we had to buy the shares, right? It won't be worthless. The intrinsic value will have it be worth something. Probably go back up here. And if that's true, we'll have to buy the shares. And if we buy the shares, this is what we'll do. We'll trade options. We'll go a month out. We'll sell a call. And we'll just do the $17 call. The IV looks good. The volume looks good. The open interest looks good. The delta is a little bit high for me. But if we bought it for 14, the delta would actually be lower than what it is. The delta would change. And the theta decay looks fine to me. What we'll do is we'll sell 1 contract, we'll just say, and then we'll do a 63 cents. Now you have the regulatory fee, the 4 cents, but 63 cents times it by 100 because 1 contract equals 100 shares. Now the difference between selling a put and selling a call is pretty much the opposite of each other. To sell a put, you're trying to get into a stock at a cheaper price, and to sell a call, you're trying to sell a stock at a higher price. Now the collateral for selling calls is you have to have 100 shares. Currently, I don't have 100 shares of SoFi because I'm already selling calls on all my shares right now. Now, the break-even price in this case would be your estimated credit or the limit price that you put in for your bid and ask plus your strike price. So in this case, it'd be $17.63 to break even. Okay. Now, if we are right about this, and let's say by the date of expiration, which is March 14th, if the stock stays $16.99 or lower, we do not have to buy the shares, and we can still get to keep that max profit at $63 or the estimated credit. Now, no matter if it goes all the way over here, we still get to keep that $63, the max profit. No matter if it's right here, $63 max profit, you get to keep the credit no matter what. Okay. Now, we don't have to buy the shares if it's $16.99 or less, or if it's at $17 or more, we have to what? Sell the shares at $17. Or if it's all the way at $18.11, guess what? We still have to sell the shares at $17. Okay. Now, the break-even price, remember it includes that. So basically, our sell price would be at basically $17.63, but we're still selling the shares at $17. It just includes the max profit, aka the credit. Now, that's that. If we like it, we review, we send it on, but I don't have enough shares. So, why would you want to do something like this? You would want to do something like this if you don't want to collect premium, or two, you're trying to get out of the position. All right. So if you're doing this, just trying to collect premium, that's cool. Remember, we like to do a 2% at least on our premium. This would be well over 2%. So this would be good premium if you're premium chasing. But at the same time, not only would you get, when it comes to selling covered calls, not only will you get just the premium, but you'll get the difference between what you bought the shares for versus what you're selling the shares for. So in this case, $14 put. And we're doing cover calls on $17. So that's a $3 difference from 14 to 17. Right? So that's $300, because $3 per share times that by 100 is what? That's $300. Plus, that's not even counting the premiums. The premiums to get in to the shares and the premiums to get out of the shares. So you would probably have close to maybe a $370 profit or a $400 profit, depending on the bid and ask and the credits that you received. That's a strategy called the wheel strategy. You're selling puts to get in, and then once you get the shares, then you're selling covered calls to get out. That's a strategy. And if you guys want me to do a video over just the strategies, guys, let me know. So the risky side of selling covered calls is we're selling it at 17. Let's say it goes to 20, right? That could be an extra $300 we could have received if we just waited and it went to $20. So the thing that is bad about this is you do cap your gains if it exceeds your strike price. That means your gains are capped. Okay? So that's the downside. But there's a lot of positives to this. You're getting paid to sell your shares, and you get to pick the strike price and what you want to sell your shares for. And if you don't have to sell your shares, in this case, because it's at $16.99 or lower, because the strike price is 17, you get to keep your shares back, and you still keep that max profit. All right, so I'm going to show you guys one that we already did. And let's do the 18.15. So we did one contract. The current price is 9 cents. Our average credit was 20. We had that theta decay. Look at that theta decay, guys. Man, where is it at? Theta decay, we bought it around 20. So we bought it right, we'll just say right there. And then theta decayed all the way down. That's good when you're the seller. So we got a total return of 55%, $11. We did this February 3rd. Expiration date is February 28th. Our break-even price is $18.70. Our current price is $16.21. We stimulate our returns. Same day. Same thing with what I showed you earlier. We got 12 days till expiration. If its price stays the same, this is what happens, and we get to keep that full credit no matter what. If stock goes down, now if the stock goes down, we get to keep that max profit faster. The max profit goes faster because it's going away from our strike price. Now, if it goes closer to our strike price or even above our strike price, we still get to keep that $20 credit, right? There's our break-even price. But anything beyond that, we lost the potential of getting more money, Okay. So in this case, let's go to the $20, like what we said. We lost the potential of an extra $130 for one contract. Okay. So that's the selling side of options. We went over the pros, we went over the cons, right? We went over what we do and how I do it. Now let's get to the buying side. AK, this is a little bit more of the riskier side that people talk about, because a lot of people want to put 100% of their position into one play. And if they right about it, they make a lot of money. If they're wrong about it, they lose all their money. Okay. So with me personally, I like an expiration date when I'm buying a call. I like to go long, January 15th, 2027, or maybe the January 16th of 2026. That's good for me. But in this case, we're going to stick with the March 14th. Okay. And we're going to make sure we hit buy, call. The options chain is still the same. Everything's still the same. So just the difference is to break even. Okay. To break even. Now, here's our share price. We got our premiums over here. We can go all the way up to 30. We go all the way down to 5. Right? For me, I like a delta of around at least 70 for when I'm buying calls. Okay. So let's try this $14 one. So the IV is looking good. The volume is looking good. The open interest is looking good. This is a delta of 84. I like that delta. So we'll buy. If we look at the theta, that's how much money we're going to lose every day from our premium. So far, it looks like the premium is $2.54. We go, we buy. Okay. Put $2 and we'll just say 54 cents because that's what they're asking. Now, the break even. The break even is the $2.54 plus our strike price. So the estimated cost, remember, because now we are buying, we're on the buying side, we don't get to keep the premium. We have to give the premium. So that's our cost. So whoever buys this, the seller will receive the credit, right? We pay the debit. So we're paying $254 for this. Okay. Now, we look. We have the break even. Break even, we lost nothing, we gain nothing. Okay? Anything beyond the break even, we make profit off of. Okay? Anything from the break even down low until we reach our strike price, we lose money. Now from this line to that dot, our strike price, that's right here, guys. Right here is how you mitigate risk. Okay? Maybe for some people, if you reach like $100, you're like, oh, I reach 50 or something. I'm down $100. You can cut your losses, right? And redo another contract if you felt the need to. Okay. For others, they're just like, dude, I don't care about it. You can have a comeback. Now, some people let it just go all the way down to $14, their strike price. Okay. Now, if that happens, you're going to lose all the premium that you paid. Now, granted, to control 100 shares, if you were just going to buy the company, which is SoFi right now, you would need $1,621 right now because of $16.21 per share. But with a call option, you're only putting up a significant amount. You're only putting up $254. So even if, guys, it goes all the way to zero, you only lose $254. Right? Versus if you were holding the shares, you would have lost $1,621. Okay? So that's the pros and that's the cons of buying calls. You have to be right about the direction, though. So if you're right about the direction, you make a decent amount of money and you only put a little bit of money up just to control 100 shares. Granted, if you did 10 contracts, you know what I'm saying, or 100 contracts, you have the chance of losing a lot of money, right? depending on how your size of your portfolio and this and that. And this is where people get in trouble, because let's say my whole entire portfolio was 25,400. People will actually do this. This is Wall Street bets people, majority of them. They'll come out here, I'm putting it all on black, or I'm putting it all on, and if they're right, they have the opportunity to gain a lot of money. But if they're wrong, you know what I'm saying, they just lost their whole entire portfolio. So be very careful. Don't be over leveraged. Now, the thing I like about this, it tells you your break even, but it also tells you the chance of profitability. So chance of profitability on this is 43.65%. But to break even, all SoFi has to do is go up 1.67%, and you break even. So that's what I like about this. It shows you how to break even, and that. So the further you go down, the safer the plays are, but the more it costs for premium. The higher you go past the share price, right, the more percentage you need to break even, but the less premium it costs, right? And these are kind of like the more risky, okay? And so I'm going to show you guys one that I already did a while ago. Now, you have the right to buy the shares if you want. If not, you would just sell your contract. And this case, I did, let me go to it, guys. I did right here. And this one, I kind of did a strategy. It's called a poor man's covered call. If you want me to do a video over strategies, let me know and I'll do it. So I did the $7 call for January 16th of 2026, strike price $7, right? So I did that. It cost me $368, right, for that. And I was right about the position. Why? Because SoFi, jumped up a lot. Jumped up a way bunch. So I had a lot of intrinsic value on that play. And so what I did was, let me purchase the shares right now so I don't have to keep on losing all that theta decay over time. And I'm just going to sell covered calls on that. And that's what I did. I exercised my options. So I was able to buy SoFi at $7, right, for 100 shares. Now, I did that at that price that I got exercised at. So I had a lot of intrinsic value. Okay. That means the option didn't expire worthless. Remember when I showed you on the selling side, you want it to expire worthless. On the buying side, you don't want it to expire worthless. And it didn't, because we were right about the direction. We were right about the play. Now, it cost me $700, right, to do that. But it cost me $368 to open up that play, right? That premium that I paid. So how much money is that in total? It cost me $10.68 per share of SoFi, okay, to do that. So when you do that, if you're doing stuff like that, you got to make sure you add that average. If you want to know your average cost, the premium that you pay to do the option, and if you exercise it, then the strike price upon that. If you don't exercise that, guys, you don't have to exercise it. You would simply just sell the position and you just walk away with your money, right? You're not obligated to buy the shares, but you do have the right to buy the shares. Okay. Now, let's do March 14th again, but we're going to sell a put. Okay. Now, the higher we go up here, the less risky it is. Kind of like the opposite of buying a call, right? Because we're trying to sell our shares, right, for a price. But the higher we go up here, the safer it is, but the more premium we have to pay. So for example, I like at least a 70 delta. So we'll find one that's a 70 delta. Let's see if this one. So this one's pretty close, a 70 delta. The volume is 2. The open interest is 39. So there's not that much people trading it, but there are a lot of people bidding for it. The IV's high, which we like a little bit. And the theta decay, I mean, it's there, but it's not that much. But the delta is pretty good. So we'll just do this one. We got one. All right. So guys, our break even would be $15.45. And how we would get that is you would take how much your bid and ask is, aka we did $2.55. Okay. And then you would subtract that from your strike price of your puts. Okay. In this case, it'd be $18. So $18 minus $2.55, that'd be $15.45. So that's how you get your break even. Now, if you're right about the direction within the expiration date, the collateral for this is money. So on the buying side, no matter if you're buying a put or buying a call, it's going to be your collateral is going to be money because you need money to buy it. It won't be shares. It's just going to be money. Okay. So you have, if you're right about the direction, you can make $1,545. And if you're wrong about the direction, the max you can lose is $255. Even if it goes all the way to $19, $100, the max you can lose is $255. And you got your break even. That's where you don't make any, you don't lose any. Okay. Now, why would somebody buy a put? You would think that the direction of the stock's going to go down within the date of expiration date. Let's say if you are right and the shares do go down, you're going to gain money on that. But at the same time, if you want to exercise your right to sell your shares at that price, what would happen is the strike price that you pick, in this case, would be $18 per share. So $18 per share times that by 100, because one contract equals 100 shares, will be $1,800, right? If we're right about that, okay, I can sell my shares for $18 per share. No matter even if it goes to $12 or $10, right? And so the price now is $16.21. Okay? That's the price now. So if you're right about that, you can sell your shares for a lot higher than what it is what the current share price is, if you're right about SoFi pulling back by the date of expiration. If you're wrong about it, you have from this dot to right before that dot to mitigate risk. Maybe you get to, right now we're at $75. You're like, oh, that's enough risk for me. I'm going to cut my losses. I'm wrong about let's say you're wrong about the direction. Okay. If you're right about the direction, let's say, Kane, I still want to keep my shares because I'm bullish on it, but I just felt that SoFi was going to pull back. That is all right. All you have to do is sell contract. Since you're buying it, you have to sell it. Okay. And then if that's everything that you like, you would just hit review and it says you're paying $255 for the right to sell 100 shares, not the obligation to, just the right to sell 100 shares of SoFi for $18 per share by March 14th. If SoFi shares aren't $18 or lower on March 14th, this option will expire worthless. And when you're the buyer of a contract, you don't want to expire worthless, right? You want to have that intrinsic value. So guys, why would you want to be on the buying side? Basically, you've seen when we buy a call or buy a put, you only put up an insignificant amount of money versus if you're putting up your whole shares, right? You have the opportunities to buy shares at a certain strike price, and you have the opportunities to sell shares at a certain strike price. And if you're wrong about that, you only lose the premiums that you're willing to pay. If you're right about that, and if you want to exercise, you would exercise at the strike price, no matter if you're buying a put or buying the shares, or aka buying a call. And you have to either sell your shares at the strike price or buy the shares at the strike price. Plus including your premium. Okay. Now the reason why you would do this, because you think you're confident in the direction of the stock. If you really want to exercise your position, you can if you're buying a put in this case, you would exercise at $18. If not, and you still want to keep your shares, you can just sell the contract back. That is options. And I have used options to grow my portfolio. Basically, options is basically hedging your portfolio just in case if stuff happens. Just different ways. With options, I'm able to grow my portfolio like this. That's with options, guys. Okay. So it's great. It's good to manage your risk. And there's advanced strategies that I can show you guys. With that being said, guys, leave a like, comment, subscribe. I have a free Telegram group in the description below if you want to join that. Also, I have a free options tracker if you want to track your own options. And if you want to see a video about that, please let me know. and that'll be in the description below. I love you guys. Peace.